Welcome everyone to episode 3 in our exploration of finance for startups and small businesses. I'm here again with Ted Wainman, of Talk Financials, and he's here to, as always, answer all of my questions around finance. So how are you doing today, Ted?
I'm good, Donny. How are you? In fact, yesterday I wasn't so good. Yesterday, I was running a workshop in Dubai for a senior leadership team of Audi VW, and I could see through the windows. It was clear blue skies, and it was hot and sunny, and it was dark and cold and rainy and miserable here in London. And you know what? Quite frankly, I just can't wait for the end of this pandemic. We can get on our airplanes and get out and meet people face to face, and not have to converse over Zoom like we are at the moment. But otherwise, I'm good.
Brilliant. Well, I'm excited as well because we want to do this in person because using our a podcasting studio and being able to sit face to face with somebody will be really good again.
Absolutely, awesome. Absolutely. So excellent. You're right. It's our third series. We're talking about equity.
Yeah, and I'm really excited about this. We talked last time around how to fund your business.
Yeah, and we looked at debt and equity together.
Yeah, exactly. So now we're going to break it down. So this episode is about equity, and the next one is around debt, if I'm correct.
You're right? Absolutely right.
Exactly. So great. I mean, so Ted, equity is one of those things that people think on the surface is really simple and really easy to understand. But I think, most startups and startup founders who've not started a business before, it can be challenging. So, where do we start? What do we talk about first?
Well, I guess that the first thing to remember with equity is as soon as you are raising finance through equity, you're giving away a piece of your pie. So if you run a business, and Donny, I know that you own your own business, and you own the whole business. You don't have to answer to anybody. You can spend all day in bed. You don't have to answer to anybody else. As soon as you've got another equity investor, you've got somebody else who has a vested interest in your business, and it changes the dynamics dramatically.
Yeah.
Okay. So you've got to remember that this is not something to be undertaken lightly. Raising additional finance, bringing in VCs, investor angels, growing my business, becoming a unicorn, that's all fine. But you've got to remember that this is changing the world in which we operate. Okay. Yeah. That's the first thing to remember.
Yeah.
So you're going to issue a share, and we talked about right at the very first one about the structure. We said every company, we talk about a limited company, has to issue one share, and that share has to have a value. So somebody has to own that share so that we can identify the owner of a business.
Yeah.
And the first thing we're going to talk about is different share classes. So we gave the example of issuing one share, but maybe we want to issue a number of different share classes.
Yeah. So what's it, I've heard about share classes. Obviously, in my business, I only have one share class. Everything's issued to me, right? So I own 100% of the company. So, what are share classes, Ted, and how do you use them?
Well, effectively, the way we use a share class is it gives different people different rights. So it's a way of bringing in owners, but not giving them all the same amount of rights. Let me give you an example. Donny, I don't know, do you own any shares in Facebook?
I do not, unfortunately.
You do not own shares. Well, when Facebook floated, I have to admit, I said I'm not going to buy shares, and that was a really big mistake on my behalf. But actually recently, or a few years ago, I did buy some shares in Facebook, mainly because they were talking about launching Libra, their cryptocurrency. And as you know, I'm a big fan of cryptocurrencies, but that's a different podcast altogether, Donny. But I bought shares in Facebook, and what we realized with Facebook, and actually I've shown you on the screen that I've given you a screenshot from their accounts. They've got different types of shares. They've got A shares and they've got B shares.
Yep.
Now, interestingly enough, you buy one of those, and I have to admit, I haven't done my research exactly, so I don't know exactly. I think you buy the A shares. Mm-hmm. The B shares have voting rights. The A shares do not have voting rights. So Zuckerberg owns about 30% of Facebook, but he owns 70% of the voting shares.
Yeah.
Therefore, if you buy a share in Facebook, you have no say over how the company is run. If you buy a share in BP, for example, you can go to the annual general meeting and you can put your hand up at the back and you can say, oh, I'm not happy with, your policy or your strategy or whatever it is. They won't listen to you because you only own a little bit. But if you get together with a bunch of other shareholders, you can actually cause a little bit of problems. These are known as active investors, for example. They invest in companies and then they want to try and change things from the outside by using their strength. Facebook, you can't do any of that because they've got B shares, which have the voting rights, but they'll only sell you the A shares.
Yeah. Well, sorry, Ted, one thing if I remember about that story about Zuckerberg, it was just really interesting because he owns a certain amount of shares so that he can't get removed very easily from the company.
We cannot, no shareholder can remove him from the board because we don't have the voting rights to be able to do that.
Yeah. Okay.
So there's an example. So maybe you want to have a different voting right. You want to say, somebody who is proactively has the opportunity to vote on who should be a director, who shouldn't be a director, and then you want other people, but you don't want to let them have any vote. I've also put up their dividend policy. So an example here is Royal Dutch Shell has 2 share classes. It has A shares and B shares. A shares are subject to Dutch withholding tax on the dividends they pay, and B shares are not. So Donny, if you're going to buy shares in Royal Dutch Shell, make sure you buy the B shares, not the A shares. Very, very important for you. You'd be surprised how many investors get that wrong. And I'll give you another example of that a little bit closer to home. One of my businesses I've set up with a friend of mine. He's not actually very active in the business, and I am active in the business, but we have different share classes, and we agree how much dividends are going to be paid to his share class and how much dividends are going to be paid to my share class. So I'm not doing all the work and he's getting rewarded for it. Okay, so there's another important distinction. So we can do that. It means that our limited company is a little bit like a partnership. If you think about the partners get paid for the amount of effort they make, whereas you don't reward the shareholders of BP different amounts because none of them are making any effort. So you might want to think about a way of rewarding or differentiating the physical input by the individuals who are actually involved in your business.
In that instance, Ted, can you still have 50% ownership of the company, but have different classes of the ownership?
So we could have, what we could do, Donny, you and I could set up a business. We could have A shares and B shares. We issue 100 A shares to you and 100 B shares to me. We still own 50% of the business because, each share has, is exactly that, is a share. But we could say that they have different dividend policies. So, if you do all the work, you get the benefit, we'll pay you a big dividend. I do no work, therefore I get no dividend. Maybe I get all the voting rights because, quite frankly, I'd never trust. No, I'm joking, of course, Donny. But, so we can agree this up front, and we can have C shares and D shares. We don't want too many. If you have too many classes of shares, it just gets really complicated. So, if you think about it, if you're trying to have, if you're going to have 50 people involved and they're all going to be doing different efforts and you want to reward them, maybe you want to be thinking about the limited liability partnership rather than this share limited liability company is going to be a better structure for you. So thinking about John Lewis, for example, is a limited liability partnership. Okay, so making sure you've got the right structure is quite important, and that's obviously what we covered in our first video.
Okay, great.
And I've put ranking there. So maybe you want to rank the shares. You want to say that if the company winds up, the A shares get the paid first and the B shares get paid last, for example.
Yeah, I think that's a really important point as well, because a lot of people who take investment don't realize that ranking is really important with VCs. And I know we'll come on to that a little bit later in talking about term sheets and stuff like that. But when you take investment and you sell your business, who gets paid first, and what do you end up with in the end? So ranking is really important as well.
Absolutely, yeah.
Perfect. So what one of the things that I've heard about, we talked about share classes here, Ted, but what are preferred shares?
Okay, well, known as preferred shares or preference shares.
Yeah.
So again, we're talking about this ranking. So preferred shares or preference shares rank ahead of ordinary shares. Now, a really good example of a preference share is as a result of the global financial crisis, Goldman Sachs got Warren Buffett, who runs Berkshire Hathaway, one of the most successful fund managers, and he invested in Goldman Sachs preference shares. Now, they're preference shares because they get a guaranteed or preferred dividend ahead of ordinary shareholders. Now, I put guaranteed in inverted commas, Donny. You and I know as well as you know as well as I do, there are only two things in the world which are guaranteed. What are they?
Death and taxes.
Death and taxes, exactly. Okay, so nothing in life is guaranteed apart from death and taxes. But the point here is that if I invest in a preference share, what that means is that I get paid before you, the ordinary shareholder. So Warren Buffett said to Goldman Sachs, you will pay me and then you can pay the rest of the shareholders. And there's also a cumulative effect. So if there isn't enough money to pay me this year, next year you have to pay me for this year and next year before you pay any of the other shareholders.
Right.
So what you can see is that preference shares ranks above an ordinary shareholder. And because it ranks above, it's a slightly lower risk to the investor, and therefore it should be a little bit cheaper to the actual company.
Right.
Okay. So I've put down here this hybrid nature of financing. So we talked about debt and equity. Debt, you have to pay the interest. Preference shares, you have to pay the dividend. So you can start to see that we've got something which is equity, but looks a little bit like debt, if that makes sense.
Right. Right. Okay.
And that's basically what a preference share is. So you can actually, you can draw up the terms of that preference share, but it just gives people a little bit more confidence. So maybe you're the VC, Donny, I want you to invest in my company. I'm going to give you preference shares. I'm going to say, I'm going to pay you a dividend of X before I pay myself, a penny, for example. And you feel, okay, I'm a bit more relaxed with that, Ted. I'll put my money in.
All right. Perfect. And okay, so we've talked about shares, we talked about share classes and preferred shares. Now, what are options? What are share options, Ted? You always see on job advertising and startups tend to do it a lot where they offer share options. What is a share option?
Absolutely. Okay. Well, let's look at what an option is first, and then we'll talk a little bit about share options. Okay. So an option is the right but not the obligation to buy or sell at a future point in time. Okay, so it's the right, not the obligation, to buy or sell at a future point in time. Okay, we have two types of options. There's what's known as a call option and a put option. A call option is the right to buy, and a put option is the right to sell. And the way to kind of remember that is that you're either calling from the market, you are buying, or you are putting into the market, you are selling.
Right.
A European option is executed at a specified date. Okay, so we're going to say you can exercise this on the 1st of January 2024, for example. An American option is executed at any time up to and including that specified date. So you don't have to wait until that date. You can do it whenever you want. Okay. Now, you don't kind of have to know about this, but the point here is that there's a lot of flexibility. So let's think about a share option scheme. Okay, Donny, I'm setting up a business. We talked about it in the first video. It's called Ted's Veg, and I'm bringing you in. So I'm going to be management. Obviously, you're going to be labor. I'm going to be putting you to hard graft.
Always.
And you're sitting there thinking, Ted, you're only going to pay me minimum wage. Well, you're lucky with minimum wage, Donny, but I'm only going to be paying you minimum wage, but I want to incentivize you. So I want to give you the opportunity to have a piece of that pie. It's not going to be a very big piece of pie, Donny, but it's going to be a piece of that pie. And so what I say to you is that you can buy shares in the company and they're going to cost you £100 each. And you're like, well, hold on a sec. I'm joining this new company and now I've actually got to pay money into the company in order to join it. And you're thinking, I'm not really happy with that. So what I could do, Don, is I could say, look, right now the shares are valued at £100 each, for example. Okay, and we're going to talk a bit about share valuation, in another video later on. But let's say we have a formula where we value them today at £100, and there's a formula that says based on the performance of the company, the sales, the profitability, the size of the balance sheet, whatever it is, we say that's how we're going to value those shares. At some point in the future, let's say those shares are worth £200. Well, if I give you the option today to buy one share at £100, but you don't have to do it, if in the future that share is worth £200, you're in the money. It means that you can buy the share for £100 and it's worth £200.
Yeah.
If, however, our company didn't quite go to plan and it kind of, it's falling apart and the share's only worth £50, you could say, no, Ted, I'm not going to exercise my option. You haven't lost any money.
Yeah. Yeah.
So the great thing about an option is it incentivizes your employees. It's a one-way bet, so they can only make money. They're not going to lose money. I mean, you may feel a bit aggrieved that you've just, sweated, a couple of years on minimum wage and feeling a bit unhappy that, you're not part owner of a unicorn. But hey, that's the risk you take.
Yeah.
The point here is that we're using these shares to incentivize people without asking them to actually physically invest money today.
Right.
And what you often find is that the share options actually vest at a point in time, for example, when the company is bought. So what we say is, rather than coming up with a formula, we say, Donny, we're looking to float the company. When we float the company, we're going to float the company for, I don't know, £1 million a share, for example. And you're sitting there thinking, this is great. I've got the option to buy one of their shares for £100. And once we're floated, I'll be able to sell it for £1 million. That's my retirement sorting.
Yeah. Perfect.
So that's basically what a share option is. It incentivizes your employees without expecting them to put any money in. And again, if they don't have to put money in, it's de-risking it for them. You're minimizing their risk. So it's a really, really good incentivization for people to have more than a stake in the business, more than just a salary, for example.
Yeah, that's awesome. So use one word there, Ted, vesting. So can you just explain a little bit about vesting? And I know, it just came out of the topic, but can you explain what vesting?
So basically, when a share option vests, it's basically a maturing. Okay, so you might have a specified date or an event on which that actual option matures, and you might say that at this point here, you're either in the money or you're out the money. So perhaps I might say to you, Donny, I've brought you in. You're my operations manager. We've got it. These are the targets. We've got to hit this particular target by this particular point, and then you have the option. The options sort of come into the money, so to speak. So vesting is really kind of looking at the kind of the event that actually happens to create the the benefit, if that makes sense.
Yeah. Okay, excellent.
So just to summarize for us, so employee share options, we're using them to attract and retain talent. So I'll go and join a company which I've got skin in the game, that I could potentially make a lot of money from. So you often hear about the secretary or the receptionist is a multi-millionaire because they were receptionists right at the very beginning. They got a couple of shares and suddenly those shares are worth a lot of money. It helps to increase productivity, you're increasing performance, you're increasing engagement, you're trying to increase the happiness of your employees. So that's really what we're trying to do, rather than me just employing you and I get all the benefit and I'm just saying, off you go, Donny, I'm a multimillionaire. What I'm doing is I'm kind of giving you a little bit more an incentive. I'm giving you a stake. So they're really, really good for incentivizing your workforce.
Yeah.
They also help to relieve cash flow, because it means, Donny, I can pay you a minimum wage and I can dangle this carrot and say, yeah, but Donny, when we float the the unicorn, you're going to be really, really rich. So I don't have to pay you too much today. Okay, so that's a rich, and especially for startup companies, cash flow is absolutely everything. So anything I can do to reduce the cash flow has got to be good.
Yeah.
And potentially it's going to increase business valuation. A business with highly engaged, highly productive, motivated employees is worth a lot more than a business with a bunch of employees who are just don't really care, and high employee turnover, etc., etc.
Mm-hmm.
There are a number of option schemes. So the EMI is the Enterprise Management Incentives, which is an option scheme run here in the UK, and it does have tax advantages. I will just put up that there are tax implications of options. Okay, so you need to investigate these and make sure you get them right. Otherwise, HMRC or your equivalent, the IRS or whoever, will come knocking on your door. So there may be tax implications when you award the share options. There may be tax implications when you exercise your share options to actually buy the share, and there may be tax implications on the sale. And these tax implications may be either capital gains or income tax, or sometimes a combination of the both. Okay. Now, I'm not a tax accountant. You need to take specific advice before you set up your scheme as to what is the best scheme for you, and fully understand the implications before you start.
Yeah, yeah. Okay. And that's a whole nother conversation there, just around the tax side of things.
Absolutely.
It's always fun.
Okay, so we're looking at employee share options and how they are different to shares. So just a little bit more on these share option schemes. So here in the UK, there are 4 HMRC approved share schemes. Now, if it's a HMRC approved share scheme, what it usually means that there are tax incentives. So there's the Enterprise Management Incentive Scheme, the EMI. There's the company share option plans, or CSOPs, share incentive plans, and save as you earn. Now, numbers 2 and 3 are typically for bigger companies, and they're company wide. So, for example, Donny, I might bring you in as my operations director, and I say, I'm going to give you this EMI share scheme, and it's just for the directors, or it's just for the senior leadership team. So it's awarded by me, and it's discretionary. And the same with the company share option plans. Share incentive plans and save as you earn are company wide. So I'll give you an example. I used to work for Flemings, the asset management company. They had a company-wide share scheme. You could save a bit of your salary and just put it into a share scheme. And because you're saving that salary, they didn't have to pay you. And when Flemings was bought by JP Morgan, the shares vested. And of course, we were all, multimillionaires. Well, I wasn't, Donny, that's why I'm still here. But a few people actually been doing that for a long time and made a substantial amount of money. And you know what? They deserved it. They've taken the risk. So it doesn't always work. Lots of people have been investing in, their share options in companies like Thomas Cook, perhaps. And the company might go bust. So it's not a one-way bet.
Yeah. Okay. All right. Perfect.
Let me just finish this share options. So there are 6 unapproved schemes here in the UK. So you might have ordinary shares, just awarding people the options for ordinary shares or preferred shares. You can issue growth shares. Growth shares are an interesting one, where you effectively issue them at a hurdle price. So there's an incentive there. So Donny, that's a bit like me saying, I'm going to give you a share, but only if they hit £400 each, and today they're at 100. So you got to earn, you got to work hard in order to get to that hurdle.
Yeah.
We might have unapproved options, which are taxed on when they're awarded. We have restricted stock units, which is taxed when they actually vest. And then employee-owned trusts, which are giving controlling stakes in businesses on behalf of employees. So this is probably outside of the scope of this conversation, but we set up a trust. The trust owns 60% of the company. The employees are involved in the trust, and effectively, again, it's another roundabout route of giving them that incentivization. They've all got stakes in the company, effectively.
Right. Okay.
Sorry, go on.
Sorry, one question, Ted. I guess basically tax implication stuff. Would the approved schemes be better to go for?
Absolutely, yes. Yeah. So if you can have and it's understanding. So you can have an approved scheme and it fits your requirements, it's definitely best to go down that route, because you can get some very, very generous tax breaks. Okay. If it doesn't fit, if you've got a specific a requirement, if there's a particular way you want to structure it for a particular reason, then you might go through the unapproved scheme. They're not illegal. It just means that they don't have the tax advantages that HMRC. So HMRC is very good, or the government, the UK government is very conscious that they want to encourage entrepreneurship. They want to encourage people to start their own business, and they're trying to give tax incentives, and they want people to employ other people. They want to grow employment, etc., etc. So all of those are really sort of big incentivized. So definitely start with the, do speak to your accountant, start with the approved schemes, see if they're fit for purpose. And even if they're close to fit for purpose, it's probably going to be better than one of the unapproved schemes.
All right, perfect. And so just make sure that I get this straight. So a share is part of the pie now, and an option is to get part of the pie later on, but I don't have to get that piece of the pie.
But to pay the price today.
Yes, but to pay today's price.
Exactly. Yeah. Okay. So it's a one-way bet. It's a bit like saying, you can bet on the winner if the horse wins, but if the horse doesn't win, then you don't have to bet.
Right. Okay.
Who wouldn't take that?
Yeah, exactly.
Bet on the horse after the race.
Yeah. Exactly. So now, you and I, let's go back to Ted's Veg for a second here, Ted. And you and I going into business, right? And you're giving me some shares. So how do we make that formal? What's the sort of agreement? Do we have to have an agreement between one another? What's the situation there?
Well, I think the simple answer to your question, Donny, is absolutely yes. We're going to need a shareholders agreement, and the way to think about a shareholders agreement is like a prenup. And Donny, I know you're married, so you definitely can't get married to me. And anyway, being married to two people, known as bigamy, is actually being married to one person too many. In fact, I say that about monogamy, but we won't go there, Donny. So yes, you're going to need a shareholders agreement. The shareholders agreement is a prenup. So let's say, as you said, you and I going into business. Obviously, I'm not gonna give you the shares, Donny. It's you and I going to go in. We're going to go in 50-50. And what we need to do is to say, well, Donny, what happens if you die? What happens if I die? Where do your shares go? Does it go to your wife, who then doesn't actually work for the business? And so I'm basically working as hard as I possibly can, and she's getting 50% of the benefit. What happens if you lose interest and you go off and do something else? Are you allowed to take money out of the business? What happens if you see a really good opportunity? Do you have to phone me up for permission to buy a new, I don't know, carrot making machine, or can you make that decision by yourself? You can start to see that, if you go into business with another person, you can end up with lots and lots of arguments, even between really, really good friends. So actually setting out the relationship formally before you jump in actually solves a lot of problems further down the line. Okay, so it's things like, the right to buy back shares. If you die, I have the right to buy your shares from you at a preset formula before they go to somebody else. All of these kind of things, all of these considerations need to be taken into account before you actually jump in and go into business with each other. Yeah. So I've given you a list of some of the questions you might ask. Can you work for another company? What if you die? What happens to your shares? Can you act without my approval? What if we disagree on something? Can you wind up the company? Can you issue more shares without my say so, perhaps, and dilute me? And again, I think we referred to The Social Network there. There's a great movie, and the example where suddenly the guy who was the CFO arrives and finds that his shareholding of whatever it was, 30%, is now 0.03%. Yeah. He was just diluted out of existence. He didn't have the shareholders agreement, and more fool him for not having it. Can you borrow money from the business? How much can you borrow? When do you have to give it back? What happens if we bring in new directors or new investors or new employees? How do we control the business? Agreeing that up front will prevent a lot of problems further down the line.
Okay, right.
So yeah, absolutely, we're going to need a shareholders agreement.
Yeah. All right. Perfect. And are there, is that easy to find? Would you recommend going to a lawyer to get one drawn up?
Yeah, you know what? I mean, Mr. Google provides quite a lot these days. So there's a lot of blank forms you can pull off the web, and you can make a start. I mean, I would almost suggest sit down and ask all of these types of questions. Just brainstorm all of the potential problems you foresee. Pull
Yeah.
a form off the internet, see if that's fit for purpose, and if you're pretty close to it, you're going to be okay. Get it all logged and signed, and printed out and signed copies, etc., etc. If you're a bit nervous, or if it's not fit for purpose, or you can't find something that really fits your specific circumstances, you know what, a couple of dollars on a lawyer, and I'd never be willing to give money to lawyers anyway, Donny, but a couple of dollars on a lawyer up front can
Yeah.
save you a huge amount of legal fees further down the line.
All right. Perfect. Perfect. So now we understand what shares are. We understand what share options are. We understand what a shareholders agreement is. We're ready to raise money. We're ready to raise financing from a VC or an angel investor. Now, there's a term term sheet. What's a term sheet?
Okay, so a term sheet, the way to think about a term sheet is like a heads of terms. Okay, so think about the Dragon's Den, for example. The Dragon's Den, they do a little bit of negotiation. Somebody pitches, some of the dragons are in, some of them out, and they come out and they say, yeah, you know what, I'll give you 5% of your company. And then the guy says, yeah, but I need some business help. And the dragon says, yeah, no, I'll help you out. Okay, that's kind of your term sheet.
Right.
And what that does is then is translated into the formal document. So when he says, I need a bit of your help, what do you mean by a bit of your help? Am I expecting you to be in the office at 9 a.m. on a Monday, or am I expecting you to be on the end of a phone call? Do I want 1 hour a month or 3 days a month? That's what's going to go into the actual the legal document. So the term sheet, sometimes referred to as heads of terms, is non-binding. So it's not legally contractually binding, but it sets out what your kind of intention is, and it's used by companies to attract investors. So if you think about a Dragon's Den, when they turn up, they say, here, I've got this great product. And then they'll talk about, I've been doing these sales. This is what the company's worth. My company's worth £1 million, for example. I'm looking to raise an extra 10% for £100,000. We're going to give you voting rights. You might be ahead of me in preference when it liquidates. If it liquidates, for example, there may be anti-dilutive provisions, investor commitments. I'm going to need you to spend at least a day a week for the first 6 months in the business, helping me kind of actually, get this thing off the ground. Okay, so basically, those are your kind of basic terms. What is it that you're actually offering, and what is it that you require? And that is what's going to then go into the legal document. So when you have the VC or the angel, the lawyers will be involved. They will take the heads of terms and turn it into the kind of the legal mumbo jumbo doublespeak that the lawyers do. Yeah. Heads of terms is English. It's what you and I understand. It's what we negotiate, and right. It drives the contents of the contract.
Okay. All right. Perfect. So it seems like some of these things definitely need some lawyer help and lawyer assistance.
Yeah. So you will have, well, you don't have to have the lawyers on board for the term sheet. The lawyers will, but if I'm an investor, if I'm a VC, I'm going to have a lawyer sitting beside me. I'm not going to invest in you without the legal documents being drawn up. Okay. Yeah. And you probably might want to have a lawyer sitting on your side of the table. So if you remember, again, we go back to the social network, the lawyer is getting him to sign the papers, but he didn't have his own lawyer. It was the company lawyer. So get your own lawyer who just looks over it. And again, it's that kind of, a couple of $100 or a couple of $1,000 invested today can actually reduce the probability of tears further down the line and a lot of acrimonious divorce, so to speak. Yeah. So quite often, watch Dragon's Den, because it's I know it's reality TV, but it is fun. But look at some of the questions the dragons ask. So somebody says, I'm looking to raise $5,000, and they go, yeah, but you haven't told me what percentage you'll go. So, they go, oh yeah, of course not. So think about, what are the questions that the dragons are constantly asking, answer those questions in your term sheet. How much are they getting? What's their return on investment? What's their rights, etc., etc. All the things that they need to know, but also you're trying to kind of you're selling to them.
Yeah. Okay. Perfect.
Well, that's everything we're going to talk about on equity, Donny.
Thanks very much for that, Ted. It was very enlightening. I think that's one of the most important topics for founders these days. They need to understand shares and how it makes up the pie, how you're going to divide the pie, how you're going to sell the pie. So that was very, very useful and very helpful.
Absolutely, and it's worth thinking a little bit. People say, "Oh, well, I'm nowhere near that," but if you start to make problems up front, if you start a business and you start to kind of structure it incorrectly, you can end up in all sorts of a tangle further down the line. So if you bring in, if I bring you in, Donny, and you say, I want no less than 30%, and I go, yeah, no problems, Donny, you've got 30%, I've got 70%. If I bring in a VC investor who says, I want 50%, I'm like, oh, hold on a sec. Well, I've got an agreement with Donny that he keeps 30%. And so if I bring in a VC who wants 50%, that means I'm only going to have 20%. And hold on a sec, but it's my company.
Yeah.
So a little bit of thought up front can avoid some acrimonious and problematic conversations further down the line.
Yeah. No, agreed. Definitely. Well, thanks again, Ted. And everyone out there, if you have any questions, comments, suggestions for topics, feel free to add them in the comments below, or get in touch with Ted at talkfinancials.com, or myself at Donny at sixberries.com. And looking forward for the next video, which will be on debt and how we can leverage debt to raise financing for your businesses as well.
Absolutely. Looking forward to it, Donny. Speak to you then.
Yeah, thanks very much, Ted.